The stock market experienced a dramatic intraday session, opening high before plunging to a new recent low at noon, only to stage a significant recovery in the afternoon. This afternoon rebound was driven by a combination of pre-CPI position squaring and tech sector short covering. While the S&P 500 closed slightly lower and the Nasdaq remained in the red, the Dow successfully pushed into positive territory, showing that buyers remain active at key support levels. The primary driver of the morning's sell-off was a sudden panic in the artificial intelligence hardware sector. A report from SemiAnalysis highlighted technical bottlenecks and delivery delays in co-packaged optics, or CPO. This triggered a sharp pullback in optical communication stocks, as investors reacted to fears that hardware delivery delays could stall the broader infrastructure build-out. However, the CPO panic did not drag down core compute leaders. NVIDIA found firm institutional support at its intraday lows, recovering rapidly to anchor the afternoon index bounce. This divergence shows that while speculative components face technical doubts, market demand for core AI silicon remains robust, and large institutions continue to view major pullbacks as buying opportunities. This intraday drama was reflected in the Volatility Index, or VIX. The VIX surged to over 23 at noon, reaching its highest level since early April, as institutions rushed to buy portfolio protection. However, as index buyers stepped in during the afternoon, VIX crashed back below 20, indicating that the move was a rapid hedging reaction rather than the start of a systemic market breakdown. The market's underlying nervousness is tied to tomorrow's release of the May Consumer Price Index. Economists expect YOY CPI to land at 4.2%, with core CPI at 2.9%. Nick Timirios of the Wall Street Journal noted that while energy prices could keep the headline number hot, core inflation is projected to be relatively mild, raising hopes for a buy-the-news relief rally. In corporate earnings, investors are focused on Oracle, which reports its quarterly results tomorrow. Oracle has become a key barometer for the AI trade, and the market is looking for concrete evidence that cloud infrastructure demand is translating into sustained revenue growth. Bullish positioning suggests investors expect strong AI backlog growth to offset broader software sector weakness. Adding to the macro backdrop are updates on U.S.-Iran negotiations. The U.S. Energy Secretary reported that oil shipping volumes through the Strait of Hormuz have increased and are expected to expand further. This geopolitical progress eased oil supply fears, causing crude prices to retreat and helping to lower near-term inflation expectations. Zooming out, the broader AI trade is undergoing a structural shift. The narrative is maturing from a pure capacity race to a monetization battle, placing heavier pressure on companies to prove their investment returns. Data from Vanda Research supports this transition, showing retail investors taking profits in semiconductor stocks to seek higher volatility speculative names elsewhere. From a technical perspective, the Magnificent 7 ETF, ticker MAGS, is showing signs of distribution. After breaking below key short-term trend lines, MAGS has triggered a double-top pattern. Technical analysts project a measured move price target of approximately 65.25, with the declining 20-day moving average acting as heavy overhead resistance. This heightened volatility is exposing structural flaws in traditional asset allocation. Bonds are increasingly positively correlated with stocks, failing to provide diversification during equity sell-offs. For modern portfolios, the traditional 60-40 model is struggling, prompting a strategic pivot toward alternative diversifiers like gold and Bitcoin. According to Vanda Research, retail investors are rotating out of semiconductor stocks and seeking higher volatility speculative names. This shift is happening alongside temporary secondary market liquidity constraints, as massive capital lockups for upcoming offerings, such as the estimated $250 billion in subscription accounts for SpaceX, temporarily reduce float in the secondary market. Beyond public equities, the private credit cycle is entering a contractionary phase. Non-bank lending, which sustained the post-2008 private equity boom, is facing illiquidity. Rising redemption demands have forced major funds to limit withdrawals, and several business development companies are now trading below their net asset values, signaling stress in shadow banking. In a market defined by technical bottlenecks, pre-CPI anxiety, and private credit stress, caution is warranted. With planned global AI capital expenditures of $3 trillion over the next 3 years, dwarfing current AI revenues of $80 billion, selective positioning is critical. Investors should prioritize cash preservation and focus on businesses with robust free cash flows.